Hello, my name is Key, CEO and co-founder of CryptoQuant. I'm going to talk about trading insights deriving from on-chain data. So, a lot of people ask us what is on-chain data. So, on-chain data is basically imagine you can see all the bank transactions around the world. So, you can see, a settlement, basically settlement data. So this data, crypto is the first kind of assets that execution and settlement happens at the same time. So using on-chain data, you can do a lot of things. For example, what if we can see supply and demand for commodities and securities in every 15 seconds? Like, for example, if I purchase orange juice in the market, and then it recorded in on-chain, and then you can basically calculate the demand for orange juice every block. For Ethereum, it's 15 seconds. So it can change monetary policy around the world a lot if you monitor supply and demand quantitatively in every 15 seconds. So, for example, like interest rates or consumer indexes. For now, crypto is still haven't been used for P2P payments. So we can, some people say it's speculative assets. So crypto is, on-chain data for now is mostly monitor who's selling or who's buying. So we can utilize on-chain data in 3 ways: tracking smart money, monitoring third-party risk, and checking fundamentals. So this is the current state of the market. So this indicator is MVRV, market value to realized value. If you track realized price and compare it to the market price right now, it says, if this indicator says 2.7, that means the average cost basis P&L for all blockchain wallets is around 170% profit. So right now, historically, cyclical-wise, we're not like cyclical top yet. This is by reading the historical patterns, but I would say like the average P&L for now is not enough to top yet. And if you see the distribution by age bands, the bitcoins that hasn't been over 6 months it takes around 50%. So whenever it gets to the cyclical top, this ratio goes below, I would say, 20%, which means 80% for now it's 50% of entire realized market cap. It took by long-term holders. So it's not like, it's early to say we're in the cyclical top, I think. As you can see, those indicators say these are pretty, sometimes they're not accurate because there are exceptions. So some people looking at transactions. So in order to see very granular level of these type of data, you have to see the transactions. So we're tracking those transactions. Some of the transactions came from illicit money or early miners, very old whales, gambling websites. So we've been investigating those transactions for about 6 years. And now we launched some innovative analytics tools for on-chain analysts. So basically, for now, on-chain metrics is pretty, it's hard to see these metrics in a granular level. So what exchange inflows, it goes skyrocketed, and then people say, oh, whales are moving, and then there's no actually trading insights out of those all exchange inflows, because it's aggregated and there are so many market participants, so many exceptions out there. So we built a cohort analysis tool so that people can filter out those transactions and then calculate one single aggregated matrix. So for example, this is a realized price comparison, old whales versus new whales. So their cost basis price is around, for old whales it's 21K, and short-term whales, which is ETFs, traditional finance, who are using custodial wallets, their cost basis is around 60K. This is a very interesting chart. So if you see short-term cohort whales, the amount of money flowing into the market is like crazy. So it's 1.8 million Bitcoins, which is around $150 billion just flowing into the market via ETFs and custodial wallets. I took a screenshot for today. So this is an unrealized profit for whales and miners. So traditional finance, their profit is around 1%, old whales 200%, small miners 130%, and institutional miners, mining companies, they're 81%. So if you, aside from the new liquidity into the market, we can say it's pretty early to take a profit for them if you see the historical patterns. And if you see OKEx, Binance wallets, cohorts, there is no significant inflows into deposit wallets, not like great sell-off for now. This is a indicator to see whales, are whales risk on or risk off. So whenever whales decided to risk on, they move their Bitcoins to derivative exchanges from spot exchanges. So this is an indicator. In green zone, old whales, they move their Bitcoins to derivative exchanges. So for now, whales are risk-on mode, which means it's highly likely we're in the bull market still, because they put their Bitcoins for collateral or to add up long positions. This is a realized cap for retail investors. That Bitcoin age bands that is under 1 month. So obviously retail is now in the market. We're kind of spiked right now. Maybe this might pause the bull market and then we go sideways for the few months. But obviously, like I said, in terms of supply and demand, it's too early to take a profit for those entities. This is a 1 year inactive supply. So 1 year inactive supply is around 70%, which means still over 1 year long-term holders, they don't sell Bitcoins right now, not like aggressively. So these are my opinions for the current state of the market. You can visit our website and then check out those leading indicators. Thank you. Do you have any questions? Okay.
Oh, hello. I'm a university student from Korea also. I want to question about just like a chaos theory, a small difference can make a big results. In real life, the people's panic leads to bank run and makes bank destroy. And I think this tendency will be more harsh in cryptocurrencies. Uh, are you ready? Are your company and system ready for emergency events like emergency events? So you can, uh, you know what other your Bitcoin
Oh, you're
prices?
saying
Yeah.
contagion risk?
Yeah.
So we actually kind of predicted FTX and Luna situation because we label their wallets and we noticed this a large amount of bitcoins flowing into the Gemini for to execute the orders for market makers. And for FTX, their reserve declined over 93% in about 2 weeks, which means you commingle customer assets to their funds. So you can see all these activities in on-chain, and a lot of companies there disclose their proof of reserves and their labels transparently. So I think on-chain data and these indicators is very helpful to see third-party risk. Okay, cool. Thank you so much.